Wonderful. Good afternoon, ladies and gentlemen. Nice to meet you again. It's Wednesday afternoon and it's Markus time. I'm really happy that you share a lifetime with me this afternoon again. And today we are talking about trading with exponential moving average, or in a shortcut, EMA. I'm really happy that you're here and we spend your time with me. We want to talk about the following topics. What is an MA, basically moving average, and what does the EMA tell you? Today is a little bit more practical part in my webinar, because we want to see some examples how to trade with it, and a short view on the difference between EMA and, of course, SMA. So I hope y'all will make sure that you stay until the end of this webinar, or later if you watch on YouTube, if you're still until the end of this video, when I want to show you how you can use MA, and basically if you really need them. This is a great point of view we want to talk about today. This is me. I'm a trader, coach, mentor, speaker. Some days involved in markets, and have my own trading community and my trading mentor community. And I'm a trader additionally to the asset management firm Born Stahlberg & Partner in Switzerland, Germany, and Tokyo, of course. And if you want to have more information, or if you want to book your own free counseling appointment, then click on trading@personality.com. Please be aware that if you book your own appointment, it's German time what you book here. And please, if you get a response from me, check your emails, please, because I have some appointments last week and no one was there. So for example, okay. So I'm partnering with Admiral Markets, which is a CFD and Forex broker with over 8,000 financial instruments. And yes, through one of the world's best trading software, MetaTrader 5 and 4, of course. So finally, if you're watching this on video or on YouTube later, please make sure that you give us a like, that you share it, or you can subscribe this wonderful channel of YouTube channel of Admiral Markets. Okay, so I say hello and wonderful good afternoon wherever you are. This was the official part of this webinar, of the introduction, and now we can talk about how are you guys. I hope you're doing good, and it's Markus afternoon time, and you can ask me everything, almost everything, except my weight and my height. That's unless you can ask whatever you want. So I hope you had a great start into this trading week, and you had a lot of success in trading. If not, you know, this is my special advice for every young trader. Please take a mentor, take a coach, take a teacher who can teach you how to trade, to learn trading by yourself during try and error in the market. It is possible, but it costs, most of the time, it costs more money than you give it to a teacher. And money is not everything. The other point is your lifetime. You will spend a lot of lifetime to figure something out what a teacher can tell you very quickly. So I guess the problem is our lifetime is very limited. So we should use it wisely wherever you are around the world. What is an EMA? Or what is an average? What is MA? It's moving average. It's an average moving factor. And this is the exponential moving average, or we say shortcut EMA, is a type of a moving average that places a greater weight and a significance on the most recent data points, not the history. The EMA is also referred to as the exponential weighted moving average. It's normal MA, but we differ between EMA and SMA. An exponential weighted moving average reacts more significantly to recent prices changes than a simply moving average, SMA, the shortcut SMA, which applies an equal weight to all observations in the period. So 200s, moving average, of course, you can differ between EMA and SMA. So SMA, 200 SMA means it's an equal weight to the full 200 periods you're watching, you observe. The EMA is more at the recent data, is more, is the greater weight is on the recent data. This is the general, this is the basically difference between EMA and SMA. Let's see. And what does the EMA tell you? And now we want to go a little bit deeper into the praxis. The 12 and 26-day exponential moving averages, EMA, are often the most quoted and analyzed short-term average, as you see 12, 26-day. So the 12 and 60-day are used to create indicators like MACD, of course, or this is the moving average convergence divergence indicator, and the percentage price oscillator shortcut PPO. In long term or in general, the 50 and 200-day EMAs are used as indicators for long-term trends. So how we can use it? So basically, when a price crosses its 200-day moving average, it's a technical signal that a reversal has occurred. Let's have a look at the chart. So, okay, here we go. I want to show you the difference between 200 moving average and EMA and SMA. So this is the daily chart from Euro USD. So we put moving average in it. Then we say, first of all, exponential 200 period. And let's give it the color, the yellow. So basically, so you can see this is the EMA. You see, it's very close to the price, to the data. And now we see the difference between an SMA, moving average, and here we see we choose simple moving average. And let's give another color. This is red. So, and here you can see the difference. The EMA is closer to the price. You can see it here maybe. For example, so you see the yellow is the EMA. It's closer to the price and it's reacting faster than the SMA. So you see that all the time, the yellow line, this is the EMA, exponential moving average. And you see it's going closer to the price, the yellow, it's closer, and it's reacting. Here's a little bit, you see the first reaction. And here the price is reacting faster than the red one. And this is what they see the big difference between EMA and SMA. So short-term traders prefer the EMA because this EMA is reacting a little bit faster than the SMA. So the SMA is the red one, you see, is reacting more slower than the yellow line. So this is the big difference. Okay, let's see another one. So we see 12, I said 12, yes. For example, yellow is 12. And now let's see 26, red one. So here we go. Now we go a little bit closer to the price. So you see a yellow is 12 and the red one is 26, of course. And there occurs signal always when the 12 crosses the 26 moving EMA, then it creates a long signal. But maybe you realize here the first time the following point. When we see the crossing of the lines, it's maybe too late. So we have to wait. But I want to show you later how you can use it properly, or maybe if you really need them. So, but this is basically. Could you understand what I try to explain? Please type a yes or no in the chat, please. I is the red on my right chart, my right screen is the chat. Please type it in. Because it's my mission to explain it in a way, even I'm the German guy here in the room, that you understand. So give me a yes or give me a no. Okay, great. Most of you is great. Yes, yes, yes. Okay, I think I'm doing it properly. Okay, fine. Thank you very much. Okay, this is basically the difference between EMA and SMA. And by the way, this is the, if you use MICD, for example, let's see, MIC, here we go. MICD, you see 12 moving exponential, moving average 12 and 26. And the smoothing period is 9. So if you use them, so you see, here we go, 12 and 26, 9 and 26. You see it's always the same situation when the price goes up. So moving the MICD, basically you don't need them. You can use, but I don't. Okay, again. Oh, here, delete, then it works. Okay, fine. So this was the basically the basic difference between EMA and SMA. So traders who employ technical analysis find moving average very useful and insightful when applied correctly. Please pay attention what I show you in the later slides. This is basically the complete description how we can use it. So, however, they realize that these signals can create havoc when used improperly or misinterpreted. Because like every indicator, they are lagging indicators, not so-called leading indicators. An RSI is a leading indicator. Moving averages are lagging indicators. First, you see what happened, and then afterwards, the indicator will occur or will show you what you could see before. Why is it? Mathematic. Think it through. There is no indicator which can tell you the future. Why not? Every indicator is calculated on what? Type in the chat box. Every indicator is calculated on what? What is the basement? What's the basic of this calculation of every indicator? What is it? Please type in the chat box. We want to make a little bit conversation. So I'm not the entertainer here. We want to learn something together. What is the basement of the calculation of every indicator? What is it? Oh, you are so smart, guys. I'm proud of you. Wonderful. I love it. Yes, indeed. That's the price. So we trade the price. We don't trade Dow Jones. We don't trade Euro USD. That's the label. But we trade the price. So every indicator is calculated on the price. Here comes the question. Do we really need indicators? Question. If you know that every indicator is calculated on the price, think it through very carefully right now. Do we really need indicators? Yes or no? Think about it. We trade the price. And an indicator is calculated on the price. Do we really need any indicator, especially this kind of moving averages? Really? Yes or no? Yes or no? What do you think? Oh, I see the answers come very slowly. Okay, yes. We need it just for confirmation and confluence of events. For confirmation, yes. So why is it? Thank you for your honesty, guys. Because I say no, we don't need them. It's our deceptive truth. It's not the ultimate truth, guys. This is very deceptive, this kind of indicators. Because, as I said, we trade the price. If you can read the price, which only can show you a mentor or coach, why should you need an indicator? Listen to the word indicator. It's an indication what you basically see. Why do you need a confirmation for something you can see in the chart? Why? I can tell you why. We are human beings. We used to think in pictures. Take this example. I say to you right now, don't think on a pink elephant. Yes. What do you have in your mind? Of course, pink elephant. Your mind is not able to think in not. You cannot thinking not. Yes, you don't have a pink elephant in your mind. Yes, you have, because your mind is only to say no after your mind has this picture in it. You have to picture it, and then you can say no. But you cannot not saying not to your mind. This is not possible. It's fantastic if you think about it that way. So, and an indicator is the same. It's like a pink elephant. Why you should need a pink elephant? You don't need them, because it's what is calculated on the price what you really trade. I want to show you a little bit later this, but keep in your mind, please. Basically, because I saw yes, no, and no is yes. Of course, you see, if you say don't think on a pink elephant, no, no, it yes, you think on a pink elephant. That's really easy. But this is how, and this is why what I want to say, we love to think in pictures. We are not computers. A computer is calculated on two numbers, 1 and 0. That's all. 1 and 0. So 1 and 0. A computer is working with 1 and 0. That's all. So, and we love to think and to make our conversation, and we make to build our decision on pictures. So the most strange picture, the strangest pictures ever we can keep in our mind. Really, really strange. If something is boring, you will forget it very quickly. But men, especially the guys among of us, we know this. The most important pictures we can keep in mind are the worst jokes ever. A boring joke you will forget, but a really dirty and a really crazy joke you can tell to your grandkids a couple of years later. But boring things you will forget. So we love to think in pictures. This is why we use indicators. And there is another point. We use indicators because, as you said in the chat right now, as a confirmation. Why do you need confirmation? Why? For what? What you can see in a chart? I can tell you. Here we go. Today, guys, deep, deep knowledge. Normally, I talk to my only in the coaching. This is really deep knowledge. Why is it? In trading, we work on a really uncertain field. In your life, it's not an uncertain field. If you are living in a secure in a safe country, of course, by the way. But if you make your job properly, there is no fear. If you make your job properly, you can work with routines, automism, and you know the result before you did your job. But in trading, every single trade you will open is first of all in risk. Why? You don't know result before. It could be a winner and it could be a loser. So this is the way we don't used to think in our life. We hate to be in risk every day. We don't do that. We buy our normal stuff in the same grocery every day. We drive with our car to the same gas station as every time. I guess you will not drive with your car to different gas stations every time cross through the street. Why not? We love our comfort zone. This is deep knowledge, guys. We love our comfort zone. We hate to leave our comfort zone. It means risk. It means fear. It means insecurities. And trading is insecurities at all. And this is the point, and this is the deeper reason. This is the real cause. You know, I believe in the karmic principle, cause and reaction. Everything in your life works with cause and reaction. So you can compare it. If your wife is yelling to you, it's just your perception. Think about it. Last week, you yelled to her. Last week, you planted the seed that you receive it right now. And this is how our mind is working. So, and therefore, we feel uncertain on the right side of the chart. We can see it. But what do we need? A confirmation. For what? Just only feelings. I want to feel a little bit more secure, a little bit more safe. This is the only reason why we are looking indicators, to get a stupid confirmation. It's not about the technique. It's about the human part. We are looking for more safeties in a complete unsecure field, and trading is risk at all. So why should we need indicators? Just a point for your thinking for the next days. Think it through, guys. Consequently, the conclusion drawn from applying a moving average to a particular market chart should be to confirm a market move or to indicate its strength. Here comes the big secret. If you can read the chart very properly, you don't need a confirmation. Because this kind of confirmation could be really, really deceptive. It's not ultimate. It's not an ultimate truth. It's a deceptive truth. Think about it. Here comes a special point. The optimal time to enter the market often passes before a moving average shows that the trend has changed. Why is it? Look at this one. Last two words. Lagging indicators. It's calculated on the price, nothing else. So this is the reason you, with an lagging indicators, or basically with an indicators, you are always too late. But if you can read the chart properly, you will never be too late. Under the circumstances of probabilities, of course, but this is not the topic for today. I give you only just some things to think about it for the next days. And maybe we will meet each other in our trading community on Trading Spotlight. Please stay at the end, then I will invite you to that, to this wonderful family. An EMA does serve to elevate the negative impact of lags to some extent because the EMA calculation places more weight on the latest data, or we should replace it to the word price. It hugs the price action a bit more tightly and reacts more quickly, but basically always too late. Why is it? Think about it. First comes the price, then the indicator. Price is more important than the indicator. First comes the price, then comes the indicator. I love it. So, my way, this is really interesting. So, okay. So here we go. Could you see this one? It's kind of, yeah, here you go. Okay, so this is desirable when an EMA is used to derive a trading entry signal, because we want to use them for having signals, of course. We talk about the EMA for having signals, not because just funny. Just we want to be fun. It's just we want to think about some signals, of course. And I want to show you, of course. So like all moving average indicators, EMAs are much better suited for trending markets. Special word, trending markets. Here's the word included, which means, oh, a trend. You know, trend is your friend. When the market is in a strong and sustained uptrend, the EMA indicator line will also show an uptrend, of course, and vice versa for a downtrend. It can never show you different things. Why is it? It's calculated on the price. First the price, then the indicator. Why should you need this indicator? Why? Learn to read the price and you will never need an indicator, except the price indicator, of course, except for that. A vigilant trader will pay attention to both the direction of the EMA line and relation of the rate of change from one bar to the next. For example, suppose the price action of a strong uptrend begins to flatten and reverse. From an opportunity cost point of view, it might be time to switch to a more bullish investment. Here we go. Let's go. Oh, where is my example? Is yeah, here, next slide. Okay, I will show you this one. So EMAs are commonly used in conjunction with other indicators to confirm significant market moves to gauge their validity. Yes, validity. Okay. I love some English words, really. For traders who trade intraday and fast-moving markets, the EMA is more applicable. Quite often, traders use EMAs to determine a trading bias. You see, again, confirmation. If an EMA on a daily chart shows a strong upward trend, an intraday trader's strategy may be to trade only the long side. And now let's go to the market. Let's go to the examples. So I delete. So first of all, you can see, I will show you this one. Here we go. You see, yellow line is the faster one, is the 12. So you see, here we come to a horizontal line. The moving average goes in a horizontal line. And then you can see slowly it goes up. So could you see it without an indicator what will happen? In the case, we cannot know before what would happen, but we can read the chart. So let's see. I will open a new one. Here we go. Daily. So it's the same situation. here on this point. Here we go. Learn to read the price. So what do we have? First of all, we had a huge move to the upper side. Give another color. Oh, damn it. Can we do it the way? No? Okay. Here we go. Let's take yellow. Okay. After every movement, you can imagine the guys, they opened a long trade here. They're having huge profits, right? If you're going long there, you are deep in profit on the upper side. If you are in profit, you need to sell. Okay, so the price is going down because we have more volume on the seller side than on the buyer side. As you know, guys, I show you this one. Sorry. Oh, it's not working here right now. So, however, can explain it. Your long may be here, for what reason, doesn't matter. Now you're in profit. If you're deep in profit, and we think about the huge money, not private traders. Private traders, 80% of all traders lose money all the time. And I guess you can tell me stories about that, right? So the 80% of false traders or losing traders are divided in 50-50. 50% of the 80% are always too early in the market, always, because they want to catch the high or the low. But most of us, we forget something. If you want to buy, what do you need on the other side of the book map? Tell in the chat box. If you want to buy something, what do you need on the other side? Type it in the chat box, please. What do you need on the other side? If you want to buy a contract, if you want to buy euro, you need to, fine, exactly. I'm really proud of you guys, really. Yes, we need someone who wants to sell on the other side. So if the price is so high and all the stupid money is jumping in, wants to buy because they think, oh, the price is rising, I need to buy, I don't want to miss the train, I want to jump in, I want to buy. Okay, who wants to sell? Who wants to sell? Of course, the people, they are in profit. And if you want to go out of the market, if you have a long position, maybe you have 2 lots long, what do you need to do? You need to sell 2 contracts. You need to sell 2 lots to keep your money from the desk. Okay. And at a special point, we have more volume on the seller side than on the buyer side. And this is the only reason, not news. Only the price, because the price is too expensive. Think about it, guys. We only can make money if we think in this way. You can make money if you buy cheap and sell expensive. That's the only way. If you sell expensive and sell cheap, you make losses. Not the sense of buying and selling, of course. But most of the people are driven by emotions. The first part, they want to be the first one in the markets. Stupid thing. Wait for the big guys. The other 50%, always too late. Why? They want to live in their comfort zone. They say, oh, let's wait. Let's wait if the 12 to this 26 moving average is crossing. Let's wait if the 50 moving average is the 200 moving average is crossing. Let's wait. And if they're feeling good and they feel comfortable, then they go in. But they forget all the time this fact. Guys, we trade the price, not Euro USD. We trade the price, and you must pay for something for contracts because you buy one lot, not €1. You buy one lot of euro. So you have to pay the price. So, and if people deep in profit, they need to sell. And at a special point, this point, we have more volume on the seller side than on the buyer side. This is the only reason why the price is dropping down. This is what only a teacher can teach you in really deep coachings, of course. It's too less time to go deeper. This is just a little bit obvious things. But I want to tell you why moving averages are really fine, but an experienced traders don't use them because he knows he don't need them. And why? They are calculated on the price. Why should I need them? I trade the price, not a moving average. And I've learned in my life, taught by my teachers, trade the price and not pictures, not the pink elephant. Trade the price. What is the big money? Huge traders, guys. Do you know? This is one of the points you miss. Okay, why do you want to trade? If you don't know who are your players, who are the players in the market? Guys, you trade with banks, with offices, with hedge funds. How many Euro USD do we have? Yes, one. There's just only one USD. And the guy in the bank in Frankfurt, in Tokyo, in New York trades the same price like you. And you ask me, what is the big money? You see, it's not a personal punishment, of course, please. Never take it personally, please. Just only to wake you up, guys. You try to work in a professional market with unprofessional education. It will never work in that way. So you see, the price goes down. Why? Not about reason, because after every movement, the price is too expensive and people, they bought cheap, they want to sell right now. Who wants to buy? People, they want to live in a comfort zone. There's so-called dump money. So this is point. What you can read now, look at this special point. What can you read here? Okay, the price went down. And now I tell you a big secret. The huge money cannot jump into the market like you and me. Our accounts are too small. We can go with one mini lot, maybe one lot. You can push the button. You can go in at 112.28. That's fine. Because there are always two lots on the other side who wants to sell or buy. But a huge trader works with thousands of lots. And a huge trader cannot jump into the market by one price. Because if you want to buy 1,000 lots, you need on the other side, if you want to you have the specific price, you need 1,000 lots on the other side who wants to sell. It's not possible. It's not possible. That's the reason why we have corrections. Because the huge money needs to jump and get in step by step, step by step. Because the price is going down. So if the price is going down, people want to sell. We have the correction traders. If you want to sell something, what do you need on the other side? If you trade the correction there, maybe. If you want, correction means you want to sell, you go short. What do you need if you want to go short? What do you need on the other side if you want to sell something? What do you need on the other side? Great. Of course, buyers. Only buyers. So the question is, who wants to buy there? Again, huge money and smart money, because they know if we have a young trend, if we have a correction, the next move must start. Must start. Here we go. And you can read here more buys. You can read it. You don't need an indicator for that. Check the candles. If you have green candles, you have more buyers than sellers into the market. And if you can see the price won't falling deeper, won't go deeper than this price here, you always have more buyers there than sellers. The volume on the buyer side is much more than on the seller side. The price must increase. It's just only about the price, not news, nothing else, just only the price. That's the point. So, and you see the price is rising up, rising up. Okay, we have some negative candles here, but you see the next candle is green again. More buyers, more volume on the buyer side. For what do you need an indicator? Learn to read the chart. That's all. That's fine. You don't need an indicator. So, and now you can see the price is going up. So where can I get in? Of course, if you see this kind of stabilization, and stabilization means more buyers than sellers in the correction, which means I can get into here, maybe with a stop below. So here you can get in. And now check the indicator. You see, here we go. The price goes up here. You see, it's the same you can see without an indicator. The price goes up here. For what do you need an indicator? For a confirmation? Just a human thing. You don't need it. And here on the upper side, you can see there is no higher high. What does it mean? This is a reversal bar. What does it tell you? It tells you more sellers than buyers. No more highs. So, and the indicators is based and calculated on the price. For what do you need then? You don't need it. Believe me, you don't need it. Learn to read the price. That's all. The information is completely the same, guys. Deep knowledge, ladies and gentlemen. Really, really deep knowledge. Okay, guys. The major difference between EMA and SMA is the sensitivity. Each one shows the changes in the data used in its calculation. More specifically, the EMA gives higher weights to the recent prices, while the SMA assigns equal weights to all values. So I have some questions. Give me time to ask your questions. It's your webinar here. What used the big actor to open a position or close the position before us? What? Just only the price operator. Just only the price. Big traders don't use any indicators. Just only the price indicator. That's all. But no moving averages, because huge money creates the price by buying and selling. Here we go. Have you ever closed the position just before the price resumed moving in your favor? Of course, yes, I do. Before my teacher taught me the right things, I was very often out of the market before the price goes in my direction. It's all I've got 7 years, years and years. I can promise you. So here we go. Those how bad the trade will continue trend. Those how bad the trade will continue trend. The trend is only created by huge money, guys. More money than you and me have in our mind. And we can imagine, believe me. In my opinion, we need the volume, but one Forex market is not relevant. We don't know the volume. That's true. But why do you know the volume? Why? What does it tell you? What? To be honest, nothing. Where's the benefit if you know if someone wants to 500 contracts or 300? In the bookmap, you won't find a name or the reason. Check the candles and you can see what happened there. That's the deceptive truth. Again, focusing on the wrong things. Believe me. And this is the reason why so many people lose money in trading. You say experienced traders don't use SMA or EMA. Is there any advantage to combine your Dow trend strategy with use of SMA? No. As you see in my Dow trading, I don't use EMAs and SMAs. They give you just only a confirmation what you only was to just see what you just can see in the charts. That's all. Can you recognize huge money from volume? Yes, I can, because huge money creates the charts, not the small money. Small money is all. Let me show you. Come on, give me please just this one thing. So let's see, of course, New Zealand Canadian dollar. You see, I hit my target. And now let's look at this one. This is sentiment trader. You see Australian, New Zealand Canadian dollar. You see this one. You see, 68% are positioned short. What the heck is going on? The trend is strong long. Private traders are short with 84%. 84% of money of private traders are short positioned. Why? Why? They want to be the first one when the price goes down. And now they lose money because the price is going up. So which means if you want to go short, you need to sell. But if you want to sell, you need someone who wants to buy. Who is buying? Who? If 48% I want to sell, that's really huge money, which means you need huge money on the buyer's side. Who wants to buy? Trend traders, movement traders. Guys, this is really deep knowledge. And if you miss this knowledge, I can give you this advice. Please, in God's sake, take a teacher. Otherwise, you will lose all your money in the market. I promise you. So, just a little bit over time. The DMA is a moving average that places a greater weight and significance on the most recent data points. So you see, you can read it by yourself. What we talked about in this session. So here we go. Where was my chat? Here's my chat. And so I like, is there an advantage? Can you read? I like your explanation and fully agree. I have some, okay. One example with gold, please. Oh, gold, of course. I don't have gold right now. Maybe next time. Okay, but this is my host. He's asking me for gold. Who is gold? Let's see. Who is gold? There's gold. Let's see the gold price. So in gold price, so without any indicators, just gold price. So you see what happens here on this point. You can see really clearly expensive price, more sellers than buyers. And then they bought again. But if you want to buy, you need someone who wants to sell. Who wants to sell there? Only if you're in profit. Then you want to sell. You satisfy the stupid buyers. They want to buy at this expensive price. And this is the point. And here again, you see no buyers anymore, more volume on the seller side. Otherwise, the price couldn't fall. That's the point. And here again, price falls down. And now the price is falling down. Why? More sellers than buyers. The reason doesn't matter. For what do you need any indicator? Read the chart. That's all, guys. That's really, really all what I have to say to this guy. Okay, that's all. It was a really, how should I say, special webinar today. Okay. If you want to wait, if you want to know more, I invite you to our trading spotlight community on tradershield.com with our group 312. Only one requirement: open a real account at Admiral Markets, put some deposit in it, you're part of the family. We can talk about everything there. And I'm really happy if we can meet there. On Friday, my wonderful congenius partner Jens is talking about the four most important Forex economic indicators. And yes, contact us if you want to get in touch with us. And I have to say, thank you. Sorry, 5 minutes over the time. Please forgive me, but I have a mission. I want to make you successful. But please follow the advices of the pros and then learn the basics, learn to read the price and learn how to can use such indicators like MS very properly and yes, correctly. So let me say thank you, guys. Maybe you will visit my homepage, tradingandpersonality.com. Otherwise, I hope we will see you next Wednesday again for the next interesting topic. It's a surprise. So have a nice day. Have a nice time. Stay cool. Be careful. Stay healthy and be careful about your thoughts. You know, they're the beginning of your actions. See you. Bye-bye, guys.